Thank you very much, and a very good evening to everyone who's joining us today. If you're based in Europe, or good afternoon to anyone who's in the US and North America, and I guess very late night for everyone in Asia. My name is Christina Aquino, and I help lead markets coverage in EMEA for Bloomberg News, and I'm also a contributor to Bloomberg TV and radio. And as mentioned, I'm very excited to welcome our guest for this fireside chat, who is Stacey Cunningham. And as mentioned, she's the president of the NYSE Group. Stacey is also the first woman to lead the exchange in its history of more than 2 centuries. And of course, the New York Stock Exchange is one of the exchanges within the group. That's the world's largest equity exchange. But in addition to that, Stacey also oversees 4 other equity exchanges with nearly $4 trillion of listed assets under management. So I think, Stacey, really you're very much an authority here when it comes to volatility, which is what our chat is going to be all about this evening. So I want to get right into it and ask you about something that's probably very close to your backyard, which is all about the IPO landscape that we've seen throughout the pandemic. And you and I have discussed, how I think the broad expectation was for IPO activity really to slow through the pandemic. But in fact, we saw the complete opposite. And I think this year alone, we're about $300 billion away from seeing $5 trillion in M&A volumes globally. Why do you think that is?
Thank you for having me, Christina. It is great to see you again. And typically when you're talking about volatility, you're talking about a quiet IPO market. So it's certainly an unusual environment to be in, where we've seen markets over the past 18 to 24 months be more volatile than usual, and yet see the IPO market be incredibly busy and much, much busier than in years past. In fact, when you look at 2020, that was a historic year for IPOs. Nobody would have expected it back in March of 2020. And when we gathered at the conference just this time last year, we were in the midst of a very busy IPO market. And at the time, I don't believe anyone expected it would continue to persist. But 2020 was a really record year for IPOs, globally raising $279 billion in just IPO proceeds. And so far, year to date in 2021, we've raised over $479 billion globally in IPO proceeds. So what was a record year in 2020 has been completely eclipsed in 2021, which is really unusual during periods of volatility. And I think there are a few different things that are driving that shift in mindset and behavior. First off, the access to capital is certainly plays a role. But 2, companies have been staying private much longer as they were large established companies. And with that, during the early days of the volatility in spring of 2020, we saw companies who had been on the sidelines have a much more expensive experience raising capital during the early days of the pandemic. And that led them to start thinking about the public markets. And once they were well received, we saw a lot of other companies starting to think about their options and will the public markets always be so easily accessible. We are starting to see a bit of a slowdown given the recent market volatility and some of the valuations that companies are seeing, but we've still had a record year, which is quite unusual.
With such a number of companies, it's quite unprecedented going public. Are there any ones in particular that you're excited about or doing particularly innovative things that you think can really change the landscape of public markets in years to come?
Well, I think there are a couple of trends. I'll talk about broader trends in the IPO market to be excited about. And one of them is how companies are going public. It has changed. And so that'll be one. And the other is the kinds of companies that are the communities that they're serving. But how companies are going public has changed. Like I mentioned, many companies have been raising capital privately. So, our mission at the NYSE is to help companies raise money so they can go out and change the world, and so that investors can share in that success alongside them and creating those opportunities. And when they're public, all investors get access to those opportunities. But many companies have chosen to stay private much longer because they did have access to capital. So when they decide to go public, they're going public for reasons that traditionally were secondary or tertiary benefits of being a public company. Things like access to liquidity for their early investors, or currency to engage in M&A, or the credibility and visibility that you get with a public listing. While traditionally the primary goal for going public was to raise money and to have access to capital, that has changed because there is access to so much private capital. And because that's changed, it's actually led companies to take a step back and think about, well, if I'm not going public to raise money as my primary goal, why do I need to do the traditional IPO that's all about raising money? And so that mindset shift was a trigger for Spotify when they went public in 2018. And they said, well, we're not going public to raise money, so we don't want to do an IPO. What if we just want to be listed on the New York Stock Exchange? And they came to us, it actually was December of 2016 that they first approached us with that idea, which really led to the birth of the direct listing. So we worked with them for a year and a half on how can they become a public company without doing the traditional IPO. And there were two particular drivers for Spotify as they were thinking about it. Daniel Ek, the CEO, wanted democratization of access. He wanted all the Spotify listeners, their customers, their stakeholders, their community to be on a level playing field, all the retail investors to have the same access to Spotify. And so he didn't like the idea of a certain subset of investors getting access in the IPO, getting information on the roadshow that wasn't necessarily widely available to everybody. He really wanted everyone to have an equal shot. So that democratization of access was an important driver for him. The CFO, Barry McCarthy, was worried about the cost of capital. And so in an IPO, when you sell shares the night before your listing day, and the next day those shares pop 100%, that seems like a great IPO, unless you're the one that sold it the night before. And so as a CFO, Barry said, well, if I'm actually not looking to raise money, why should I let some investors get 100% return when early investors and the company itself could get a better price in the open market? And so that really was the genesis of the direct listing. What we've seen during this busy IPO cycle and public listing cycle, I should say more broadly, number of companies are following suit and choosing their path to the public markets, not just the traditional route of an IPO, but considering an IPO if that fits their needs, also considering a direct listing if that fits their goals and needs, or a SPAC, which has become certainly a widely adopted tool for public markets over the past couple of years. So that's one area that's sort of an exciting trend, that there's that opportunity.
Yeah, these are very interesting and exciting trends indeed. And I'm glad you mentioned retail investors, because that was actually what my next question was going to be about. And I think, from the vantage point of anyone in Europe or even in the UK, the rise of retail investors, particularly in the US, has been fascinating to watch, just because there isn't much of that big of a scale of a retail investor over here. And so what we've seen in the US, where, you have the growth of meme stocks or the idea of FinTalk, right, where you have these really young, what we call them traders, shall we say, giving advice on how to get into investing over TikTok, of all channels, and all of these other trends. How do you think this impacts the broader level of participation in public markets? And do you think it should be encouraged? Are there ways that we can make it better for these investors who may not know as much about getting involved as your seasoned investor?
Yeah, absolutely. And capital markets, capitalism more broadly, works when it's a story of shared success. So the more we can get participation in the markets, that's important. One other area, though, just to go back to your prior question on IPOs, because I think this is important too. One of the things that I was excited about when we've looked at companies that are coming public over the past year is the fact that their businesses are often designed to help small businesses. Those small to mid-sized businesses getting new technologies and new tools to make them more effective will be an important trend for us to manage that wealth divide that we see. If large companies are able to grow in the public markets and small companies are suffering, we're not going to have that equality that's really important for us to work toward. And so seeing companies like Toast, who are providing restaurants and small businesses with technology to make their day-to-day lives more efficient and easier, was really rewarding. I'll tell you, in the early days of the pandemic, when many of the restaurants in New York City had been closed, I went to my local restaurant and said, "How are you guys holding up?" And they said, "Oh, it's great. We got Toast today. We're so much better off." So I'm really encouraged, as somebody who has a vantage point of the new and exciting companies that are coming to market, to see companies like Toast or Compass helping individual business leaders in the retail market markets, or so many others, or mission-driven companies like Warby Parker and others that are really focused on giving back right from the start of their life as a public company. Those are the kinds of things that are going to address problems more broadly that we need to, as a society, address. And the other part of that is making sure that that opportunity is shared. And so the retail investor community is where we need to get more inclusion. They need to be educated, and not all retail investors are the same. And when I talk about educated, I'm not talking about whether or not they're smart investors. We need to make sure that they have access to the information that informs them, right? So I talked about SPACs. There are a lot of SPACs out in the market. They need to have disclosures so that retail investors are aware of what conflicts might exist in the SPAC structure, of what opportunities that are out there. Those disclosures are an important part of what we do in getting access to those investors. And so, with seeing the rise of the retail investor has led to some interesting phenomenon for certainly this year. We started this year off with the meme stock craze and seeing a lot of retail activity that drove, let's say, interesting behavior in some securities. That's a little concerning to me, frankly. Even though the markets functioned the way they're designed to function, people don't expect to see market moves in securities like that. And there are two sides to every trade, and not all retail investors are the same. So very often I would hear from let's call it the Reddit community or some of the online chat rooms that have been talking about retail stocks, and we understand the risks, we're willing to take them, and we know you don't need to protect us from those risks. But they're also trading against other retail investors who perhaps didn't expect to see those market moves. And so we need to recognize the fact that our markets are an ecosystem, and they function well when the entire ecosystem, like our world, is functioning well. So that's certainly an area of focus. Financial literacy is a big part of my focus when we think about how to make sure people understand how the markets interact and how to make sure we can keep it a safe environment for others.
Yeah, it's very interesting indeed. And I think, when you're talking about the democratization of market participation, I think what we're really seeing this play out particularly is in the ESG space, which I know is one of the areas that you're very excited about. It's a very hot area, and everyone really has an increased focus on it. And I think, it's probably one of these spaces that kind of lends itself very well to paying attention to the smaller investors, the smaller stakeholders in the space, just because they have been, they've been very vocal about expressing their demands and their desires for companies to start showing that they care about these issues. They care about climate change or environmental or social issues, diversity, and things like that. Do you think, how is this something that, with the increase of individual retail investors, is this something that could change the landscape of ESG, or how have you seen it starting to change that landscape now?
Well, first off, I'll say that ESG itself is not new, right? There are companies that have been focused on their stakeholder communities for decades, and so that's not entirely new. How we talk about it is evolving. The number of stakeholders who are raising their voices to be part of the conversation is increasing. And so, as you mentioned, employees, communities, different new generations are coming out and saying what drives them and what's more important to them, which is part of why we're seeing companies who are coming to market also focused on the impact that they can make right out of the gate. I mean, when I buy my Warby Parker glasses, I feel good knowing that somebody else is getting a pair of glasses because I bought one. And so I want to do more business with them. And their stakeholders are delivering that message. And so we're seeing companies who are focused on the benefits that they're driving more broadly around the world. The ESG more broadly can be, it's an evolving business, and the investors are also asking for changes that they want to see companies take, and that's a good thing. And there can be commercial decisions that are made that also support the positive change that we want to see, so they're not necessarily in conflict. The amount of U.S. professionally managed assets that are invested in ESG strategies grew by 42% to $1 in every $3 of U.S. managed assets from 2018 through 2020. So that's a significant growth, and the U.S. is lagging Europe by far. So the U.S. is just starting to catch up, where Europe has really been a leader with respect to ESG investment, ESG focus from companies and investors. So that's a trend that's certainly picking up more more steam. I think it's important that we have realistic goals set out so that we set ourselves up for success. At the NYSE, we focus a lot on the solutions that we can deliver by tapping in to the power of our community. So with respect to environmental markets, frankly, we've been in the environmental markets since 2003 when we first invested in the climate exchange and then fully acquired it a few years later, because we do recognize the value and the importance of renewable energy and products. Carbon offset markets are another area where we've spent a lot of focus in delivering solutions to our customers across ICE and NYSE. We have just announced a partnership with the Intrinsic Exchange Group that will allow us to list natural asset companies. And the goal here is to harness the intrinsic value in natural assets, ecosystem services, so sovereigns and others who have these assets can list them as a company and investors can invest in their future. So that's a nature positive exercise. That's a way we can all lean in and provide an opportunity for others to promote the success they want to see with their investment dollars. That's, things like this, or our diversity council that's focused on providing candidates for board seats for corporations. They have more independent directors sourced from our NYC CEO community. Those are solutions that we're focusing on. That's the approach that we take, along with disclosures, so that companies and their investors then have access to information that they need to know where do they want to invest and who do they want to partner with. Those are the kinds of things that will drive success around ESG, and the data behind all of that is certainly an area that we provide a lot of information so people can make those investment decisions. And the SEC here in the US will continue to focus on those disclosures so investors have access to that information.
Yeah, it's really interesting. You're talking about there are these solutions, there's this data that really makes it very possible for companies to get into this space. And really, more broadly, think about the broader stakeholder community beyond just kind of their immediate shareholders. This is a question I wanted to ask you. It was born out of one of the previous panels, which was all about stakeholder capitalism. And one of the panelists was Sarah Fryer, who was the CEO of Nextdoor, and she was talking about that sort of trade-off between growth and engagement, where you're thinking about really a broader ecosystem, like you were talking about, right? That it's not just your shareholders who are in this, but you also have to think about your consumers and your broader stakeholder group. But
I think that's a short-term. I'm sorry to interrupt you, Christine, but I think that's a short-term trade-off, and I'm sure Sarah would agree, right? Because that's the benefit. If you're focused on the short term, you might make some short-term trade-offs, but over the long term, you're going to win because your broader stakeholder community, you're building trust, and trust is one of the most important things that you can have when you're running a business, running a company, and engaging with your stakeholders. When you build their trust, they're more likely to continue to do business with you. Your investors are more likely to believe in you for the long term if you've proven that you're going to deliver over the long term what you set out to do. And so, yes, definitely, if you're talking about quarterly results, there are going to be trade-offs at moments in time, but that long-term strategy will play out and will be the right way to go.
Yeah, that's great, because I was going to ask you what your words of wisdom would be for any company who's hesitating still to navigate that trade-off. So that's perfect. I'm sure they will appreciate hearing about that.
Well, they need to articulate it. Communication is a big part of that, making sure that you've described what your intentions are. I love to say no Mad Libs. If you leave holes in the story, people create crazy stories. So I don't know if you're familiar with the books, but they leave parts of the story out and allow you to write in and fill in the blanks. And that when we do that, when we create an environment where we're not filling in the whole story, that's when people start to lose confidence. And so it's important when you have a long-term strategy to articulate what you're going to do. There are certain investors that just want the quarterly results. And so, I'm not saying, I don't mean to make it seem so simple, but you have to know that if you're focused on the long term, it will come.
Absolutely. And, speaking of long term, we have a number of events and just trends over this last 20 months that have really affected everyone, right? Whether you're a company, you're a world leader, you're a CEO, or even ordinary consumers. I think the idea of inflation is definitely front of mind for a lot of people at the moment. And, we're entering this new era of higher interest rates, a possible sea change in various policies. how do you think companies who are still looking to kind of go public or access public funds in some way, how do you think they can navigate this sea change?
Well, I think your point, Christine, on the challenges that we've faced across the board over the past year and a half is real, right? And it's not, we as individuals, we have faced them on a number of fronts, right? So one single person is facing a challenge running a business, at home as a family member, in society. We have literally been challenged on every front simultaneously as we're thinking about the impact of global events on our businesses, what it means for inflation, all of those things. And so it's been a really challenging time, and we've been tested. I think we've risen to the challenge, and companies and the like are constantly, the information is changing from day to day. I mean, I just think back to a year and a half ago, and we were saying, let's communicate to our team each day because the pandemic is unfolding so rapidly. We want to share information, even if we're not updating with any new information. We'll just say the same thing, that we're still here, we're still hearing, we're still watching it. And there was new information every single day. That really hasn't slowed down. I mean, we're reading about new variants of the virus on a daily basis. So when you think about things like inflation, it really, the most important skill right now for a company is to be nimble and to be able to react and to communicate clearly throughout this process, because they need to plan for all sorts of conditions, impact of the supply chain, inflation, and others. And so just being able to wake up each day, see what the news is bringing, and react is an important part of this particular environment right now.
Thank you very much, Stacey. I'm afraid we're out of time, but it's been an absolute pleasure chatting with you, even if you can join us here in Paris. But very nice to speak with you virtually, and I'm sure our participants enjoyed that conversation. So thank you very much.
Thank you, Christine. It's wonderful to be with you today.